Hello. This is to introduce trade finance instruments which are commonly used in international trade, and we'll address four of them, namely the open account, the advance payment, the documentary collection, and the letter of credit. But before that, let's explain some of the additional risks that uh, international trade entail as compared to local trade. And these are some of the most prominent risks, which include the existence of cultural differences between countries and different nations, foreign exchange risk and exchange controls, distance, different laws, different languages, money laundering and terrorist financing, sanctions, and customs and duties. And let's address a couple of them. For instance, cultural differences that exist and what risks that they can entail. I remember some time ago, uh, I used to work for a bank in Sudan, and we issued a letter of credit to an exporter in a Western country to import old newspaper that the importer wanted to recycle and produce cartons. And when the goods arrived, it turned out that those newspaper contained inappropriate pictures, and hence the customs duty refused to release them to the importer. And we, as an issuing bank, were obligated to effect payment to the exporter, despite that the goods were destroyed by the customs duty. And obviously, the exporter did not understand, and the importer did not expect that such inappropriate pictures will lead to the destruction of the newspaper, and the importer just lost his money. Uh, Also, in trade finance, international trade finance, unlike local trade, there would be likely an additional currency, or a currency which is neither the currency of the importer or the exporter. And this will hence create a risk of either the importer paying more, or the exporter receiving less money than what was anticipated, depending upon the fluctuation of the currencies. The other risks, such as different laws or causes of risk, such as distance, geographic distance, can create uh, losses for either the importer or the exporter. And let's address some of the instruments and see how the risks are distributed between the buyer and the seller, the exporter and the importer. So here are the four instruments, which are the open account, the advance payment, the documentary collection, and the documentary credit, also known as letter of credit. Starting with the open account, and this depicts a seller in one country and a buyer in another country, and they agree to buy and sell the goods. So the seller starts first by shipping the goods and sending the documents over to the buyer to release the goods. Hence, the buyer acts secondly by transferring the amounts to the seller. Clearly, in this scenario, the seller bears most of the risk, because he sends his goods to the buyer before receiving the payment, and the risk could be that he would not receive his payment, or the payment will be delayed by the buyer or the buyer's country. Accordingly, it is important for the seller in this case to have adequate controls that will manage and mitigate the risks mentioned, And this may include that he is confident of the buyer's integrity and the buyer's financial solvency, as well as that the country of the buyer is of an acceptable risk. On the other side of the continuum, we have the advance payment, wherein we have again the seller in one country and the buyer in another country. However, this time the buyer initiates the transaction by transferring the sums to the seller and waiting for the seller to ship the goods and send the documents over to the buyer to release the goods. And obviously, the risk this time will be borne by the buyer. And what kind of risks will there be? It is the non receipt of the goods themselves, despite having transferred the amounts, or the delay in receipt of the goods, especially if the timing is important for the buyer, i.e., to keep production of the goods he manufactures, the supply chain, or if he wants to sell the goods before uh, a certain occasion, such as Eid or Christmas. These are examples. So it is important for the buyer to manage those kinds of risks and to have controls such as confidence in the seller's integrity and the seller's ability to perform, as well as an acceptable risk of the seller's country. Just imagine the open account and the advance payment being on a continuum, according to which the open account represents the most risk for the seller, and the advance payment represents the most risk for the buyer. There are other instruments which try to better distribute the risks among the two parties. That is the documentary collection. And the documentary collections are subject, when they are stated, subject to URC 522, which is a set of rules by the International Chamber of Commerce to help the parties define their responsibilities and be aware of what actions are required from each. Let's start with the documentary collection and see how it operates. There is the seller again and the buyer, two countries, not necessarily, of course, but we are speaking of international trade. Here, the seller ships the goods first to the buyer, but you would observe that this time the documents have not been sent directly by the seller to the buyer. In this, under documentary collection, the seller submits the documents to his bank. Let's assume that the bank is in China, with instructions as where to send the goods, to whom, and importantly, how the goods must be delivered. So the seller's bank would send the documents as instructed to the buyer's bank in his domicile, in his country. Let's assume that it is Bank of Khartoum in Sudan, and Bank of Khartoum would read the instructions relating to the delivery of the documents, and this could be that the documents to be released to the buyer against payment of the value of those goods, of those documents, as stated on the cover letter sent by the seller's bank, or other instructions like the goods could be released to the buyer against his or her acceptance of a bill of exchange. Now let's assume that the instructions are to deliver the goods to the buyer against payment. Then the bank will receive payment and deliver the documents to the buyer, who would go and release her goods, and the payment will go through the banking system back to the bank in China and then to the seller. Uh, there is a question as to whether the documentary collection is risk free to the seller, and it is important for the seller to also appreciate what risks are involved in the transaction that are not yet resolved by this instrument of payment. One risk to note for the seller is that the banks are not obligated to effect payment. Uh, it is true that the documents will not be released and cannot be released to should not be released to the buyer if the documents are against payment unless the buyer pays. But the buyer, if the buyer doesn't pay, there is no obligation on the banks to effect the payment. And in case of a bill of exchange being signed, the banks are not obligated to pay the bill's value at maturity unless the documents are equalized, i.e., that from the first instance, the instructions require those banks to undertake to pay at maturity. And additionally, if the goods can be released without the need for the documents, then that's a risk for the seller. If the goods are shipped, for instance, by trucks, the drive of the trucks will not wait for the presentation of the truck consignment note to release the goods. He would want to deliver the goods and leave. So the goods, the documents here are not a document are not documents of title with which only allow for release of goods against their presentation. This is important to know for the seller that it is not risk free. Moving on to the documentary credit, which is also known by a number of names like letter of credit. The name is not the criterion. The content that a bank undertakes to pay is the criterion of whether the instrument is the letter of credit or not. And in simple words, there is a seller and buyer, and the bank undertakes to pay the seller if the seller presents the documents required by the letter of credit. There are so many other details in the letter of credit that we will address in another presentation. So those are the four instruments used in trade finance, and the distribution of risks among these four as follows. Open account is risky on the seller, advance payment is risky on the buyer, and documentary collection and letter of credit have some distribution of risks among between the seller and the buyer that each of them should be aware of. And still uh, there is a new instrument of payment which is known by the name BPO, bank payment obligation, which is an attempt to introduce electronic uh, payment methods, and that's still in the early stages, although it has been introduced since 2013. Thank you so much for listening to this presentation, and I look forward to seeing you when we address the letter of credit. Thank you.